How's it going, guys? Welcome back to mentfx, and in this video we're going to take a small path away from the very in-depth complexities we've been dealing with on this channel and talk about basic simple liquidity concepts and basically take a look at it from the perspective of retail versus smart money investing and what it usually looks like and why it usually stands that retail is caught a lot of the time on the wrong side of the market. So I was actually chatting with some of my other friends that are really good traders and basically talking about GJ right now. And both of us are very bearish. Both of us believe that overall prices should come and clear the lows here. Again, this is not financial advice of any sort, but ultimately we're looking for the bearish trend that was put in motion ever since this and then has continued to hold itself downwards. We are looking for that to continue holding itself downwards and continue running the liquidity at the bottom side of the market. And in this case, that liquidity resting under this low. So before we go further, let's quickly understand how liquidity works and why what we do works and how we look to think about every market. So when we're taking a look at this overall market and even this down move, what we need to recognize about any swing high or swing low that exists in the market, and a swing high is ultimately a wick up and two wicks on each side that are lower, right? That's just a swing, right? That's why it's literally called a swing. And on the other side, it's something that looks like this, right? There's a wick down and there's candles on each end that are lower, and that makes it a swing low. This makes it a swing high. So very quickly, if we were to just look at even this market right here with nothing more but finding the swing highs and swing lows, you will see you have a swing high here, 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 a swing high right there, there, and even here, right? So these are kind of all the swing highs that exist on this daily time frame currently. And on the other end, if you want to find the swing lows, ultimately the same pattern. If we just zoom in so you guys can see it very quickly, you have this wick that is below the two wicks or the two bodies on either side. Therefore, you have a swing low. You have a swing low, right? A wick, swing low, a wick that is lower than the two bodies or wicks on opposite sides, right? A swing low here, a swing low here, a swing low here, a swing low here, right? So these are all areas ultimately of just normal swing lows. So these are all examples of swing lows that exist with the basic assumption that, you know, you have a wick and a body or wick on each side that makes it a low, and you have a wick and a body on each side that is lower, making it a swing high. So these are ultimately all swing highs and swing lows in the market. And based on the assumption of smart money, what we do and what high-end hedge fund traders do, institutional traders, all of that, all of those people that function with order books and anything of that nature, what they see is the clusters of orders, or what their algorithms do is they find where these swing lows and highs exist, because they understand that above and below these swing highs and lows is what is known as liquidity. So if we just draw that out, let's very quickly go ahead and delete all these brush tools. So stay with me for a second. So ultimately what we understand is there's liquidity there, there's liquidity there, there was liquidity here, it was cleared by this high, there's liquidity here, there is liquidity here, which was cleared by this, there's liquidity up there, up above that, up above this, right? And on the other end of that, if we go ahead and put this on the bottom, you have liquidity that exists at this swing low, this swing low, this swing low, this swing low, this swing low that was cleared, this swing low, and all of that was cleared. You see all this buildup of liquidity was cleared by this move. Liquidity at the bottom there, 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 at the bottom there, some at the bottom of this, right? Equal lows, but also there are some swings in there. And currently that's basically how my eyes function when I look at any market. So ultimately what you have to recognize is liquidity exists on both sides of the market at all times. Now there's going to be liquidity that exists on one side of the market more often than another. And when you start to put in a bias or a basis for going short, like a structural move down, what's happening is the liquidity that now exists at the lows is the liquidity that becomes runnable, right? So this is the liquidity that basically smart money wants to run, because they've begun to assume a ton of orders at the supply and demand zones near the higher ends of the range. So what they're doing is they're entering these huge buys before the sells, clearing intermediary liquidity up inside of the intermediary highs in there, clearing that out with their supply and demand zones, and dropping back down to run larger liquidity pools at the bottom of people or hedge funds or companies or governments that are looking to hold their positions or their protected stops in or around the lows here, trying to find and pinpoint these lows, right? And trying to buy into them or emotionally get involved. And this will occur on every single time frame. So you can see this exact same setup present right here. The bias or the basis has already kind of become bearish. And if you notice, as it comes down and breaks structure, we make intermediary liquidity on the high. That's this liquidity right here. And after that liquidity is made, we come to run that liquidity to use that, the big buy before the sell, right? So that's your buy before the sell, also known as your supply zone. That comes and breaks down and creates a new point of liquidity at the bottom. Comes right back up to tap into that previous buy before the sell, same as this high right here. So if you look at that high, that's the equivalent to this right here. Comes to tap into that, and then is met with new bearish pressure to come and run the liquidity point at the bottom. So ultimately, what you need to recognize about these markets is that liquidity, which is basically money in the market, exists on both sides of the market. And that liquidity usually exists, not usually, but it does exist in the forms of buy stops and sell stops. And what we do is we assume that every swing ultimately in the market, even every wick, which is a little bit more of a complex subject, so we're not going to talk about that right now, but ultimately every swing in the market across all time frames. So if we go to a 4 hour, there's a swing here, a swing here, a swing here, a swing here, and these are all other points of liquidity on lower time frames. What we assume is that these points in the market, above and below them, have buy stops and sell stops. So let's talk about that for a second. So instead of just thinking about this as liquidity, what we do is we think about this as an area of buy stops. Similarly, instead of just thinking about all these as liquidity, they are ultimately sell stops. The exact same thing, but it's an easier way to start to think about it because it's going to help in your future projection of price. So when we, for instance, so let's delete this, let's make this buy stops. All right, let's delete some of this, delete these and make these sell stops. So ultimately, the way you need to start thinking about it, and this is just a simpler look at the market, is that when price puts in motion many sell stops that can be ran and allows itself to run buy stops on an already bearish bias, then we begin to put in motion order flow that should remain bearish until the liquidity runs on the bottom side in the form of sell stops is complete, right? So we have sell stops there, in which case we have sell stops here, in which case we have sell stops here. And the market has continued to deliver in this bearish sense. So we can delete all these liquidity highs at the top just to not get too confused, to maybe make allow the chart to be a little bit more understandable for a lot of you, right? So ultimately, this is the easiest way to kind of view this market from this standpoint without looking at any in-depth things just yet. So we have this run of buy stops with the wicks you see at the high here. The run of those occur, and we begin to run sell stops on the bottom side, including all these sell stops here. As this sell stop is created, what we begin to have, and the reason there's sell stops here is because people are not just looking to sell this. What they're doing is they're looking to, again, call the bottoms of markets using the tools they've been taught, such as areas of support and resistance. So there's a really good chance that a lot of retail, especially if they trade a more swing-like strategy, were looking for buys at these points. And maybe as they saw this engulfing candle, maybe at the close of this candle here, they were looking to take buys up to come and run new highs, and we're wrong. Same thing happened here. They probably saw this, thought it was a small fake out, big engulfing candle, began to look for buys and got stopped out. And this is ultimately what happens in the market because even though retail say they follow structure, what they actually do is they follow zones. And when they follow the zones, what happens is the actual structure that's underlying the market, in this case, which is clearly bearish right now, is what's actually being delivered, coming to hit every buy before the sell, as we spoke about earlier, right? The last up move before the down move, also with inefficiency present, therefore a unmitigated supply and demand zone. So a very potent and important zone in the market, and continues to deliver to the bottom side to keep running sell stops. Similarly, as you've seen in my videos previously uploaded, I spoke about the idea of not allowing price to change your mind just because it looks bullish. And this is the idea of that. We are still bearish and there's nothing to assume but for price to continue delivering that to the sell stops on the bottom side. And again, just by zooming out on this and conducting some analysis as you normally would as retail, because I used to trade a lot of retail and I used to try to make it work for myself. This was a very, very long time ago, but ultimately, if you zoom out on this and take a look at it very quickly, I can almost 100% guarantee you that your setups, especially if you're someone that's been trading retail for a while, look a little something like this. You have this support resistance line across the market here, just drawn out. You probably have this resistance drawn out here. I'm just doing my best to kind of show you guys what you probably see. Maybe you have a small resistance drawn all the way up here, just because there was a little bit of mitigation there. Just because there's all these little taps, and then maybe you had this channel drawn in like so, right? So if you just consider what's happening here on a retail basis, ultimately what you have is retail looking to already buy this point here, stop loss below potentially these lows, right, to continue higher. You have, or even to this next resistance, right? You have other retail looking to already buy this breakout, and seeing this rejection. So maybe their stop loss is below these lows here, looking to take it higher to here or even here, right? So a lot of retail is forcing buys at this point in GJ. I'm pretty sure. I think I was talking with my friend about it, and he said that a lot of people were messaging him, and he basically swing trades, and he's been shorting since in around these areas and these areas, and he shorted a long time ago, and he's making a shit ton of money off of it, again with partials, proper management. And everyone still reaches out to him telling him, you know, oh no, it's bullish, it's bullish, it's bullish. And usually that bullish bias is coming from the fact that people are looking at the market this way, or even seeing this intermediary support right here. So a lot of people might be watching this one too and saying, okay, it's time to buy. And when they do that, what you can already see is that these areas, these swing lows that we just spoke about, are acting as sell stops, because what's happening is people that are already getting into buys or are looking to get into buys here are placing more and more sell stops below all of these areas here, right? AKA stop losses. A stop loss is a sell stop, because what happens is if you're buying and the stop loss gets hit, you're selling off your position. So you're selling, therefore it's a sell stop. So not only are there breakout traders looking for the sell, but there's also people that have bought looking to get out of their position here. And this happens not just in the retail space, but across many disciplines, such as banks, hedge funds, institutions, dumber governments, dumber companies, just a shit ton of people. And this is why hedge funds go out of business, because they function across these exact same emotional guidelines. And this is why a lot of them go bankrupt. They, one, don't have proper risk management in place, which is one of the key elements of trading, but also because they overload themselves up on trades like this, looking for that bullish bias to be put in motion. Now, I'm not saying that it's guaranteed to come down, but based on a probabilistic approach of smart money and the way money likes to be delivered when it comes to certain sell stops resting in the market and buy stops resting in the market, it is under smart money's interest currently to continue delivering to at least the bottom side, to keep running lows, and to deliver to inefficient price action within those lower areas, and then to potentially continue going short. And this is why when retail begins to get involved at these areas of support and try to target resistance, and by the way, you can already see that just by doing a little bit of retail analysis, how confusing this can get. Because if you just keep going just a little bit, you have this area of support resistance right here, right? So that's been tapped. Maybe you can increase it to that point, right? So ultimately, you're looking at this striped pajama. This is what I call the striped pajamas, because a striped pajama is just, you know, where are you buying? Are you buying in the white? Are you buying in the gray? Are you selling in the gray? What are you doing? Are you confirming? So this is why a lot of the time retail gets very, very confusing, because it's ultimately extremely chaotic. What happens is, if you really think about what retail is, any point in the market can act as support and resistance. This is why it gets so crazy. And again, under proper and strict risk management, you can still be profitable trading retail. But again, the main thing we're telling you and trying to teach you here is to understand the market from a standpoint of where sell stops and buy stops exist, and then to use structure to understand how that delivery of price may come. So like we said, above every swing high and every swing low, there are buy stops above the swing highs. So buy stops up here, right? So just like we showed you right here, buy stops right there, and sell stops below these points here, right? Below any swing low. So you can see how here the sell stops were ran before we could continue this bullish structure. And back here, if you remember, we were actually very bullish. The market was delivering bullish. It's correct. Kept going bullish, breaking structure, creating buy stops, having sell stops, but understanding that structure is bullish means that we are using the points of demand for institutions at these points, or smart money at these points, to keep going long. And as a result, we keep going long. And as we break more highs and take out the large buy stops of people that are trying to force sells into the market, how so? By looking at the support and resistance areas here, looking to sell, you can see these doji candles or pin bars, whatever you may want to call them. This is how retail gets confused. They see breaks like this and instantly assume bearish structure and want to get involved. They're not viewing structure from a standpoint of institutional smart money delivery. Okay, so we break that buy stop again. We create new buy stops at the high, and that is again created by, as we understand, the demand zone present at these lows right here. And again, price comes back to come into those demand zones, clears sell stops within those demand zones, and again begins to run buy stops. Clearly, we are still bullish. We create more buy stops and we create a new area to go long. And now we create more buy stops. And again, at this point, I was still long on this market. I was looking for buys inside of this area here. And lo and behold, there were buys available there that then began to go to break even and then came to break through. And as we had this major displacement in price, which I teach in my previous YouTube lesson, so make sure you check that out, we understood that we had a shift into a bearish structure. And now our new and left behind supply zones, which have controlled this price move down, again, by way of buying to sell on behalf of smart money, we understand that now the buy stops are becoming protected because they're on the end of the institutions, and that price delivery is now bearish. So instead of looking at all the support lines in here and the resistance lines in here and trying to buy here, what we're doing is we're looking for a way to get in on the institutional move, which is now bearish, and run the next sell stops. New sell stops created by the last up move before the down move. Price gumps to it perfectly. Again, inefficient areas getting filled in, breaks down. Price leaving behind new supply zones, price coming up to it perfectly, and now selling down through the sell stops. So again, our assumption still remains bearish as it remained bullish back here. Even though we were wrong about this bullish move, when it finally broke, we allowed ourselves to then shift our buys and begin to trade within the new delivery of price, right? And we were able to confirm it. In this case now, we have a new delivery of price. Therefore, we will stick to this delivery of price to keep running sell stops instead of allowing ourselves to be clouded by the idea that it looks like there's a nice support and resistance right here. Because yes, although it's true there is a nice support here, there's nothing saying it's going to hold. And a lot of retail that's starting to get involved on these breaks of trend lines, on the breakout of the channel, on the support lines are probably not guaranteed, because we never know 100%, are probably going to continue getting liquidated by these pushes down. So ultimately, hopefully this shows you a very large difference between the retail way of trading and the smart money retail way of trading. Because remember, smart money is still a retail way of looking at the market because we are still retail traders and we are still looking to get involved on our own with our own accounts. So we are retail traders, but the disconnect exists between the type of mass retail knowledge available and the way it is taught versus the way that following a smart money order flow delivery is taught. And ultimately, even though at the core of retail and of smart money is structure, the way that smart money views structure and looks to continue it versus the way that retail views structure and looks to trade the support and resistance of those areas is where the big disconnect happens and where retail begins to fail or get smaller trades out of their RR, and where smart money looks to succeed. And this is why a lot of people and mentors have made the switch ultimately from retail trading to smart money trading. And even though it was profitable to trade retail, there is a lot more profitability to be found in the concepts and underlying notions found behind smart money. And that is why the shift is made. Because when you understand how price delivers to sell stops and how it delivers by taking out certain buy stops along the way, you begin to formulate entire plans for yourself that literally are based on the idea of liquidation, manipulation, and price delivery using other people's liquidity, right? And what we do when we see these buy stops and sell stops at these swings is we ultimately are trading almost like a prop firm, almost like a hedge fund that views a chart that doesn't have really candles on it, but has areas shown on it where liquidity resides, which is where a lot of banks sell into and buy from, because they understand that at that point, they have the ability to pick up all the excess money laying there, such as these sell stops, to take them in a certain direction and continue before going and proceeding to deliver price the way the institutional order flow is currently running. Now, if you want to get deeper on this and have a more structured approach to what we teach and understand this from a better standpoint, a better sense of view, and have a few easier steps to actually utilize what we teach, check out the link in the down in the area right under the screen, or read over the description. We have a very, very vibrant and active community. We have people getting funded with prop firms. Basically a lot of the time, almost every month, we have over 3 to 4 people that get funded. So if you want to take your own knowledge to the next level and you want to be part of a community, be able to speak with me, have one-on-ones with me, then by all means feel free to join. Otherwise, I hope you guys enjoyed this free video. I hope you take something from it. I hope this helps your understanding how liquidity resides in the market. And I hope that you guys have a profitable week, profitable month, and a profitable year. Thank you so much, guys, and I'll see you guys in the next video.